Deutsche Bank just lost $5.7 billion. Will they go bust? I'm going to explain this to you in 3 simple, fast steps. And if you're asking yourself right now, why on earth is George wearing a baseball hat? Because it is my birthday today, and my awesome team went out and bought me an End the Fed baseball hat. So today, we're wearing it on the video. Step number 1, Deutsche Bank is structurally unprofitable. How does this work? We've got the typical bank balance sheet, assets on the left, liabilities on the right. And I've abbreviated that because most of the big bank CEOs are asses and they lie all the time. Our bank CEO in this example is Double D, Diamond Dave. And Diamond, of course, is spelled D-I-M-O-N. He is laughing all the time because he is making so much money. On the asset side of his balance sheet, he's got the loans and reserves. Pre-quantitative easing, the way this worked is there would be a spread on what they paid depositors and what they would lend out. In other words, a spread on what they had to pay for their reserves and what they would loan out into the real economy. And I know that they don't need these deposits to lend money. So all the modern banking guys and gals out there, calm down, calm down. But in this example, we'll say that they were making 7% on the loans, they were paying 3% on the deposits, and they were getting 0% on the reserves that were held at the Federal Reserve Bank. This is the way the normal banking system worked prior to the GFC. Post-GFC, everything changes. The central banks, in this case the Federal Reserve, started paying the banks for the reserves that they kept with the Fed. Let's say it's 2%. This is called IOR, interest on reserves, and IOER, interest on excess reserves. In this new type of model, they'd pay the depositors 0. They'd lend out at 4%, so there's still a 4% spread, and they'd get paid 2% on the reserves. So if we translate this into revenue and expenses, in this case, for easy math, let's say they're making $50,000 in revenue, they've got $20,000 of expenses, therefore they're making $30,000. This is a more profitable model. They're making $50,000 because now, again, they're being paid on their reserves. They're paying out $0, so their net profit is $50,000. Pretty straightforward. Now, let's move over to Deutsche Bank. There are 2 huge differences with the way Deutsche runs the retail side of their business. And we'll get to the other side in step number 2. But for the retail component, because interest rates have gone so low in Europe, the difference between the loans and the deposits, or the spread, is very, very low. To add insult to injury, the European Central Bank, instead of paying them for their reserves like the Fed pays Diamond Dave, the ECB actually charges Deutsche Bank. So their IOR, or interest on reserves, is in the negative. So that's no longer a profit stream for them. It's actually an expense. So when you combine that with the lower spreads, it's very difficult for them to make money. Using similar numbers to what we used over here, on the revenue side, they're only making $5,000. On the expense side, 0. So a total net profit of only $5,000. If they continue to have negative interest rates, or if negative rates go even lower, sooner or later, the government on that side of the pond, and in my opinion, this side as well, is going to have to go cashless. If they went cashless, then Deutsche Bank could charge their depositors 3%. And this gets really confusing, so let's focus here and try to get our minds around this. What has actually happened, and this is why I started using red on this side and green, is the expense side of the balance sheet and the revenue side of the balance sheet has actually swapped. In a normal banking situation, the assets produce the revenue and the liabilities produce the expenses. But with negative interest rates, all of a sudden, the assets are the expenses and the liabilities produce the revenue. So in this case, they'd lend out at a negative 1%. The ECB would charge them 1% to hold their reserves, and they'd charge depositors 3%. So their expenses would be a negative 10,000. Their revenue would be a positive 20,000 for a net profit of $10,000. The business model gets even more bizarre. The bank's loans would now become expenses. So why on earth would they ever lend any money if they're just creating an expense for themselves? The only way is if they knew that loan that they created formed a deposit that they would keep at their bank. So let's think this through. If you're someone who's buying a home and you're getting a mortgage, you would have to get that loan from the seller's bank. Why? Because then the bank would know that that loan that they're giving you and keeping as an asset or an expense on their balance sheet would become a liability at the same bank and pay them revenue in the form of the negative interest rate that they are charging the seller who's getting the money from your loan. The problem with Deutsche Bank right now is they are stuck between this business model and this business model. They've got the worst of both. In other words, they're not making much money on the loans. They're being charged on the reserves, but they're not able to make money on the deposits yet because they haven't taken interest rates negative for their customers. So they've got red on this side of the balance sheet, red on that side of the balance sheet, and red with their reserves. That's why they are structurally unprofitable, until which time the government comes in and takes everything cashless. And in my humble opinion, I think that this is why Deutsche Bank is transitioning from being a trading model or a speculative model into the retail banking side, because they see this cashless society coming down the pipeline. And if everyone is required to keep 100% of their liquidity as a deposit, that means that there's just more revenue opportunity for Deutsche Bank. Step number 2, why does JP Morgan have huge profits while at the same time Deutsche Bank has huge losses? It starts with IOR, just like we talked about in step number 1. But secondly, it's because the majority of the sovereign debt in Europe is trading with a negative yield. So let's go back to the way that the government sells their debt. A lot of that debt they sell is purchased by the market makers who are the primary dealers. So the government spends all this money, they issue these bonds, those bonds go down to the primary dealers who give the government that cash. Those bonds go onto the balance sheet of these banks. They can use those in the repo market. They can use them in a lot of different ways to make money. But as they sit on their balance sheet, JP Morgan is making 2% and Deutsche Bank is losing 1%. In other words, JP Morgan is making money on the loans, making money on the reserves, and they're making money on the bonds, where Deutsche Bank is potentially losing money on the loans, definitely losing money on the reserves, and they're losing money in the form of interest that they have to pay the government to be forced to buy their debt. But it gets a little more complicated because right now we're just talking about interest rates. But remember, there's a price to the bond as well. There's an inverse relationship. So as the yield of the bond goes down, the price of that bond actually goes up. So if Deutsche Bank had a lot of these bonds on their balance sheet and interest rates actually went further negative and they sold a lot of those bonds, they could realize a profit or a capital gain. And the rates don't have to go down by much. If we pull up this bond calculator, you'll see that if the rates go down even less than 1%, that can be a gain of over 10%. Okay. Now let's go to this Reuters article that shows the main form of profit for Deutsche Bank was their bond trading. That's right. So let's think about this. If I'm Deutsche Bank and I know that I'm getting my butt handed to me by these negative interest rates, what am I going to do to hedge my bets? I'm going to go out there and buy even more bonds than I'm required to buy, because if negative rates go lower and there's more pressure put on the retail side of what I do, then I know I'm going to make up at least a little bit of that money with the value of those bonds increasing because those negative interest rates are going down. My whole point here is this becomes a huge problem for Deutsche Bank. The only way that they're making money is through a vehicle that on the retail side forces them to lose money. So if rates go up just slightly, they don't have to go positive, but they go a little less negative. That means they're going to lose money on the bond trading desk and they're going to be losing money on the retail side. Step number 3, is there any way out for Deutsche Bank? We explore that further by diving into a recent episode of Macro Voices with one of my favorites, Russell Napier. Here, Russell is referring to MMT. So I think it's potent. I think it's like a drug. It's very hard to stop. And I think it's debilitating in the long run. And if you have something that's potent, addictive, and debilitating, I think it changes the next 20 to 30 years. I want your listeners to think what happens the day that modern monetary theory is announced in Europe. What happens to long-term bond yields, which are currently close to zero? I would argue that they would jump by 150 to 200 basis points very, very quickly indeed. Those jumps in long-term bond yields in some way offset the positive move you had by infusing money into the real economy at the short end. That has to be stopped. Institutional investors know the addictive nature of this policy. They know longer outlooks of this policy. If you're holding 10, 15, 20-year government debt, you really want to get out as soon as possible. What he's referring to here specifically is the risk of inflation. I think most savers in Europe, whether they're institutions or whether they're in the private sector, will be scrambling to get their savings out of the system. And this is where perhaps only capital controls can allow the state, allow the central bankers to continue to manipulate those long-term interest rates as they provide the dose of morphine which is supposed to invigorate the patient. But as most of us know, it really numbs the patient. So what Russell is saying is Christine Lagarde comes in and starts MMT. Money is raining down on all of the people in the real economy. This has the tendency to create massive inflation. The problem is that that inflation will make the interest rates on the long end of the yield curve go up. This would crush the economy. To prevent that from happening, what Russell assumes would be the solution from the central banks in the governments is they would institute capital controls. The reason they're instituting capital controls is to keep people from taking their money out of the system who are worried about that inflation. Because there's not as many sellers of these long bonds as there would be without capital controls, that allows the central bank to manage the long end of the yield curve and keep it from getting out of hand. This goes back to Deutsche Bank in the sense that all of this money printing, inflation, and capital controls would lead to higher interest rates. And remember, what is crushing Deutsche Bank right now is lower interest rates and a negative IOR. The bottom line is that higher interest rates, if this plays out, like Russell is talking about, would be a bailout, a huge bailout for Deutsche Bank. And you may be saying to yourself, yeah, George, I get it, but there's no way the European economy can handle positive interest rates right now. But we have to remember the difference between nominal rates and real rates. If the rate of inflation is up near 10% and all of the interest rates are in the positive but below the level of inflation, in real terms, the interest rates are still negative. To be clear, this may or may not play out. Russell, although he's extremely smart, could be wrong. So it takes us back to our original question, will Deutsche Bank go bust? And to answer that, let's go right back to that Reuters article. Back in 2016, there was a report that the government, the German government, had a rescue plan that was being prepared in case Deutsche Bank was unable to raise sufficient new capital. And this was to settle a litigation, but they're in much, much worse shape now than they were back in 2016. Of course, the German finance ministry was in charge of setting up this alleged bailout for Deutsche Bank. And the person who would have overseen that entire bailout plan would have been the German economic minister, who was a gentleman by the name of Sigmar Gabriel. Now you may be asking yourself, well, George, okay, fine. That was way back in 2016. Why are you telling me this now? Well, let's go right back to Reuters and you'll find out. Last week, and we're talking about January 2020, Deutsche Bank appointed to its supervisory board former German government minister Sigmar Gabriel. If I'm Deutsche Bank and I want the German government to bail me out, who else am I going to hire other than the former economic minister? So to answer the question, will Deutsche Bank go bust? Believe it or not, I'm going to have to say no. Because they're either going to get MMT, which is going to boost interest rates, or the German government is going to simply bail them out. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.